I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, good to be with you, Jim, and here we are. It's Friday again.
The U.S. dollar jumps after Treasury yields went up on jobs data in the U.S. What's happening with that?
Yeah, well, that's sort of a mix here. There was news came out of Europe that they did something, and then in contrasting with the jobs report of a month ago, there was something that was good or okay in this one. This is always conjecture because the amount of rigging they're doing and the calculation of that number is amazing, and I really don't follow it that closely, but it can move markets for an hour or so when it comes out. But at any rate, I think the big thing here today is the breakdown in the long Treasury bond market. We've been using the TLT on that one, the ETF that trades on it. And we'll guess 2 weeks ago, we noticed a pattern in here where it had done the rally into earlier in the year, that huge rally which generated all kinds of upside exhaustions and technical stuff for us, and we advise, get out short and term, whatever. And then there's been two big rallies since. And then a couple of weeks ago noticed that going back over about 12 years, there was this pattern of a big high, a lesser high, and then a lesser high, three of them. So then this needed to do one more rally up to a thing called a Keltner band, and we got that. And then after that, it should, for the price to break down, generate a MACD sell. That's sort of like two momentum line things. And as of this week, we got the MACD sell. So that is a done deal. So the direction for the long bond price is down. And, I guess here it failed at 121 in here. And, there was an important low at 113 level in June. So that would be more of an immediate target. It could go further. Also, during the week, we were looking at a couple of European bond issues, the Portuguese one, and it looked like it was trying to turn around and increase in yield. And this week's action is an important step, so it's making the turn, and it could be pulling others up. Actually, we should review the action in the European bond market, which went absolutely bizarre on a rally on lowering yields, where the German yield got down to 0.06% or something like that. That was all early in the year. The U.S. long bond peaked out in February, and we noted that, and then said that this would lead the rise and reversal in the European bond market, and they turned on April. So, Now, how bad can it get? Well, let's just see if it gets down, on the case of the TLT in the U.S., down to 113, and we'll review it there. But at any rate, let's put it this way, it's going our way. And this then has had part of other action in here. The U.S. stock market, the senior index, is sold off. But the financial side, the banks, BKX, and the broker-dealers, XBD, have rallied very smartly here, but they had been behind the action and not performing well, and it looks like they're just doing a quick catch-up here to get some momentum on to reverse. And so it looks good. Now, on the broker-dealers index, that's where all the action is, all the underwritings, new issues, IPOs, whatever. And we're looking for that one, once it breaks down, to head down quite dramatically. The financial side has been very good, but it's now starting to, we did it last summer in July when on the banks and financials noted that the action was suggesting that there were very nice widows and orphans short. So they got hit very hard down into August and then hit again into the 2nd of October, and then actually quite a good rebound now. So financials are precarious. The breakdown in the long treasuries is very important.
OPEC released a confidential report. So obviously it was
a confidential report.
Yes, saying they think low oil prices could last for at least 5 years.
I'd agree with that. It's supply-demand, and the new way of drilling for oil is an important technological breakout. Of course, it was that fracking was first more successful in nat gas, and was more of a continental market for nat gas, and they used to trade up to $12 or $13 on the good times, and then down to maybe $4 or $5. But what the revolution there did is moved natural gas prices down to a new low regime, and that's where we were in the second quarter of 2014, where we're looking for crude oil to rally up to that May or June, which it did. I think got to 107, and then down in a major way. We compared it to crude oil to gold, and noted that in previous serious declines in crude oil, that it could fall to 1/3 of its high in gold terms, or to 1/4 if it gets really bad. So that then, in rough numbers, put the target for crude oil at 37, which it hit a while ago, or if it really gets bad, the quarter decline would be to 27. I think it's probable. The technological revolution going on, and a lot of capacity coming on outside of the crazy Middle East. So, yeah, OPEC is recognizing that the prices are going to be down. But also, this is within a weakening commodities. This is also a feature of the post-bubble condition, is weak commodities. And as we like to say about the U.S. dollar, or in its role as the senior currency, that one of the other features of a post-bubble condition is that the senior currency becomes chronically strong against most currencies and most commodities for most of the time. And as of this week, we've got the U.S. dollar at a new high for the move, and I think it can go up. Now, part of the mechanism for the senior currency becoming chronically strong is that during the bubble, a lot of the debt was written in New York and is due and payable in U.S. dollars in New York. So just that debt service can be a continuous bid for the U.S. dollar, because let's face it, if you're out there in Bolivia and you owe money into New York, you got to sell something, whether it's tin or metals or whatever, in order to get your hands on U.S. dollars in order to meet your obligations in New York. It's kind of a rough game, but I think it's going to continue.
Well, people were pointing out the U.S. borrowed so much money overseas from China and so on, but they didn't factor in how much money had been borrowed from the U.S.
I guess so. Also, we've been reading that the Chinese have been consistent sellers of treasuries, and you take a look at, every once in a while I see a chart showing the holdings of the Federal Reserve of treasuries, and it's scary. It shows the what it owns in other quality issues, but they own huge amounts of medium to longer dated treasuries, and that is really scary. And this breakdown in the bond here is important. Now, also, the other thing, speaking of central banks, saw that the Bank of Japan owns a huge amount of equity ETFs in the Tokyo market. So here they got long this because they get this idea that their dollar reserves or whatever reserves they have that are supposed to be backing the currency, that's all sort of gone away. So they then look at the reserves they have and they get this idea that we've got to get a better return out of it. So instead of sitting there and owning gold as a reserve, which was traditionally the reserve that one would hold, they were owning a lot of dollar reserves. That's all right, and but maybe just short term. But then you got zero interest rates there, so they get no there. So then they've gone out and practiced modern portfolio theory and have bought equities. So it's. I think the modern central banking is about to get a very serious instruction in markets. And foolishness, and the end result of it will be, as the central bankers will probably go back to realizing that, hey, you own gold and you got a proper reserve, but that's sometime in the future. And in the meantime, what this has done, of course, with the stronger dollar and weaker commodities, you had a brief rally going on for the grains here recently. And they now have sold off a bit. They had a high here early in October. They rallied up to 300 on the index, and since then they've been following a declining 200-day moving average down, with this week giving up a few points, but not really breaking down. And then base metals, they had a rally coming out of the August crash. Didn't go too far, didn't get above the 50-day moving average, and then came down. So that low in August 24th was 257. Then here in end of September, there were some pressures, 259 on the index. Now it's sitting at 260. So, they're just not going anywhere, these commodities. And recently you had a rally in lumber. It got up there, got overbought, and gave one of our reverse springboard sell signals. It's heading down again. So this makes any of the stocks that are in the resource side, the base metal mining stocks, not doing at a brief rally, not doing well. The oil patch stocks, the symbol there is XLE, not doing so well. Hey, I hate to be so gloomy on a Friday.
We'll have more with Bob Hoye right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Bob Hoye. Bob, what's happening with gold and silver right now?
We had a rally out of there. Interestingly enough, is that gold did rally in U.S. dollar terms with the crisis in August, and it got up to 1170. That low back there in July was 1072, and then the next rally took it up to 3 weeks ago at 1191, and still a pretty good rally, more than $100 out of it, and it had trouble staying above the 200-day moving average, and then I guess last week, a week and a bit ago, our ChartWorks came out with it, and the commitment of traders numbers came out, and between what the speculative trader was doing and the commercial trader was doing and how fast it was happening was dangerous, and that's what we actually called that report, Gold is Dangerous. And then about 4 days later came up with another one, same thing, sort of thing, commitment of traders figures were bad, and then it was going to head down. So here we are now. We're down to almost 1100, so from 1191 to 1102, that's quite a drop. Now, silver has dropped even more because when precious metals decline, silver usually follows faster than does gold. So, a fair sell-off in here going on.
Now, is there any recognition that silver is a commodity that's actually used and it doesn't just sit there in bars in some bank? The silver is the metal that the silver bugs are a very stubborn group, and you can sit down and take a look at the supply-demand numbers and look at the number of new mines coming on stream and the number of old mines going off and the consumption, all that sort of stuff. And sure, every year there's a shortfall of silver. But when I started in advising mining companies in the mid-70s, I realized that they were all hung up on supply-demand numbers, and I pointed out to them that, hey, there's a different way you can do this, and that's through changes in the credit markets, and then just doing technical work on the price of, say, looking at copper or gold or whatever, and you just can't make forecasts on any metal based upon supply-demand analysis, and the bear market in silver is particularly instructive in that since 2011, when they had all kinds of shortfalls in supply, and you've had this long bear market in silver. So, and when you're in changing credit conditions, we call it the gold-silver ratio becomes the metallic credit spread. So in good times, the spread between gold and silver narrows, and in bad times it widens, and it's been widening lately here. So considering supply and demand analysis in gold or silver or any other metal, we've never found a way to make money out of it, so we advise people to stay away from any study that goes on about shortfalls of silver and just to look at what's going on in the credit markets and in the technical analysis of the metal itself. And my colleague just made a good call on this. So now what this is doing is that for the gold shares, which we would look at as an investment, we like to see gold shares beginning to outperform the bullion price, and that was started a couple of month and a half ago, and build a little base there, and then if it got above the 50-day moving average, that would be good, and it did, and it popped a bit of a rally, and it took the gold stocks with it, but as of a week and a half ago, with these signals we got out here on the metals itself, it was time to stand aside. We didn't actually recommend for investors to accumulate gold stocks a couple of months ago. There was a nice rally out of it, but this test now is very important, and also if you've got heavy weather in the big stock market, gold stocks won't go anywhere. But what we're thinking on this now is that we're getting closer to the point where investors should consider accumulating gold stocks, but we're not actually doing it yet. We're just getting ready for it, watching for maybe further setbacks in the big markets. Bob, thanks a lot for chatting with us.
Good to be with you, Jim, and we look forward to talking next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Check out our popular YouTube channel, Talk Digital Network. Find us on Twitter at TalkDigitalNet. You can forward questions or comments to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.